Hello everyone, Happy New Year and welcome to today's episode of The Upside. I'm Kyle Cheropita. Like we do every month, on this show we'll be counting down the top FidelityConnects highlights from the prior month. Connects is first presented as a live webcast for financial professionals, and then released on replay for all as a video podcast with new episodes dropping daily. So let's take a look at December's big stories. Mid-month, we welcomed head of Quant Index Solutions Bobby Barnes into our new Montreal studio. Bobby sat down with host Marilyn Bardagi, and in this clip, we'll hear about how Fidelity's impressive quant team in Boston works with the portfolio managers. Take a look.
Bobby, it's quite an eventful day today. Both the Bank of Canada and the Fed met for the last time this year to decide how they go about interest rates, and we'll get to it. But before we do, I'd like you to talk to us about the quantitative research team. So how did the team come about? What is it exactly that you do? And that data, is it only used for our quant products, or is it also used by some of our fundamental, portfolio managers here at Fidelity?
Sure, yeah. There's a lot to unpack there. So I'll start with my favorite story, which is that unbeknownst to a lot of people, Fidelity's been doing quant for a very long time. So we hired our first one back in 1965, and his job was to help the firm understand how to use the computer because there was only one back in those days. But if we fast forward. In particular, I would talk about how the quant took shape around the mid-2000s, because that's more similar to what it is today. And so historically, quant had been an independent silo separate from our fundamental department. And then in the mid-2000s is when they integrated the two together to identify stocks that are attractive both fundamentally and quantitatively. And so that's how I spent most of my career. I started full-time in 2009, working alongside with many of the portfolio managers that Fidelity Canada knows and has money invested with. And I created the models, the quant models, using the best ideas and approaches, both quantitatively and fundamentally. And it's those insights that led to the factor ETFs that we ended up launching, both here in Canada and in the US. Having said that, where we are now is even more integrated. And so, depending on which specific quant team you're talking about, we've got teams that are like the ones that I started on. We call them the embedded equity team, where you're working one-on-one with quant portfolio managers. We also have, because quant naturally is very, technically inclined, we used our quant expertise to build technologies to help augment the fundamental job. And so what that might look like would be, as you can imagine, our fundamental analysts who are experts in every area or industry across the globe, they publish tremendous amounts of research daily. And one of the technologies we've built is an AI engine that will help portfolio managers summarize all the research that's published internally and elevate the most attractive ideas that they should add to their portfolio. And so that's one way of enhancing the portfolio management job. We do the same thing with analysts, where if you think about the day-to-day job of an analyst, you're on earnings calls and you're summarizing the information that is presented by management on those calls. There are only so many hours in a day, so you can't sit in on all the calls. And so we've built systems that will do that for the analyst, and again, summarize all the relevant information to help speed up the number of rocks that they can uncover, as we like to call it.
Right. You've also said when we spoke to prep this call that you do work alongside, portfolio managers like Will Danov, Joel Tillinghast.
Yep.
So how do they use that research? You mentioned, making it easier to read some of the, analyst reports and whatnot, but how do they look at the data that you provide for them? How do they use it?
So the job of a quantitative analyst is that are partnered with our portfolio managers, like a Will and a Joel, is twofold. One is to provide stock selection ideas, and then the other is to help them with portfolio construction. The former, however, usually what happens, like if I'm working with any portfolio manager in my prior role, because now I'm managing the ETF business. But we still have other quantitative analysts who are working directly with those portfolio managers on a day-to-day. They will, sit with a Will and say, "Okay, Will, talk to me about your investment philosophy. How would you articulate that?" And then the job of the quant is to take, what's said and translate that to, okay, If Will just said, I like, companies that have, durable moats and are compounders over time. What does that mean quantitatively? And then develop a model that's really custom tailored to Will and his process. And so that's what I did over the course of many years. And many of our quantitative analysts are still doing that today. And that's what that will look like, is they'll surface those ideas that are custom tailored to the portfolio manager based off of their investment philosophy, but then also help them create a portfolio based off of those ideas, with the idea of maximizing exposure to the most attractive stocks while minimizing any unintended risks.
In early December, Chris Kuiper joined the show. Chris is VP Research at Fidelity Digital Assets, and he spoke with host Colin Randall about the digital assets roller coaster of 2025. They also spoke about major regulatory developments, the Genius Act in the US and the Stablecoin Act here in Canada. And here they are with more.
2025 has been an interesting year of announcements related to stablecoins from governments in the US and of course just recently here in Canada. The recent federal budget, the Canadian government unveiled a new framework that would regulate stablecoins. And this, of course, follows the passing of the Genius Act in the US back in July. Maybe we can start with the basics. What is a stablecoin and what is it used for?
Right, so the simple definition of a stablecoin is it's a cryptocurrency. So it's like all these other tokens that sit on a blockchain. It runs on these crypto rails and networks, but it's stable. Its design is to not fluctuate in value against a currency like the US dollar or the Canadian dollar. So it's pegged to another currency or sometimes a commodity like there's gold and stuff like that. And therefore it's backed by this other currency. It has a reserve behind it. Now that's different than Bitcoin. There's nothing, redeeming that you can redeem for Bitcoin. You can't bring your Bitcoin in and redeem it for something else. It's just Bitcoin. It's like a commodity, like something is just gold, or even today, it's just $1. So the idea of the stablecoin is that it's pegged, it doesn't fluctuate. And then what is it used for? Three main things, really. And stablecoins have been on an absolute run in terms of their creation. We've gotten hundreds of billions of dollars worth of stablecoins nowadays because they found this perfect product market fit. I think you could argue stablecoins are probably the most successful product, if you will, that's come out of crypto. And the three main uses we see it being used for is number one, trading pairs and DeFi. So if you're on an exchange, you want to trade out of your position in Bitcoin or Ethereum, you want to go to something stable and get volatility off your books. You can go to the US dollar, but then your exchange is going to be set up to accept and take US dollars or Canadian dollars with the whole banking system. Whereas it's a lot easier to just trade into a stable coin. These are the most highest traded pairs out there. And then all of DeFi uses stablecoins. So if you're borrowing or lending on chain, that all uses stablecoins. And then the other two is just moving money. So moving money across borders is a big one. Remittances, much cheaper to move stablecoins anywhere in the world rather than use a wire, ACH, a company like Western Union, something like that. Those have average fees around the world of 7%. And then just payments. You can use stablecoins to pay for things because it is a stable currency, just like using the Canadian dollar or the US dollar.
Right. And there are centralized stablecoins, which are what are being announced by the governments. There are also decentralized stablecoins, picking up on that conversation we were having about Solana. What's the difference between the two?
Right. So what I think you're getting at is whether or not there's a central issuer behind the coin. And most stablecoins today, and by far the most popular ones today, are all centralized, if you will, meaning they are issued by a company or an organization. So this company will take in dollars. People will send or wire in something like US dollars, and then they will mint or create the stablecoin on the blockchain. And then they're responsible for holding that asset or investing those dollars to back the stablecoin. And then they can also do the reverse. You can send your stablecoins in and say, I'd like to redeem this, and then they'll give you back the dollars and burn it. Now that's done at a very high level with like big players and institutions, but that's the point of a centralized issuer. Not as popular yet are these decentralized solutions where they do everything on the blockchain. So there's no central company, party, issuer. It's all done with software on the blockchain with these smart contracts where you send in some kind of collateral like Bitcoin or Ethereum, and they'll issue you a stable coin. Now, because of this, they're often over collateralized. So you have to send in more of something like a Bitcoin because you can't send in dollars usually. So they're not as popular, but mostly what we're talking about is centralized issuers. Now that's different than what you noted about the governments, though. Whether or not the government is involved is a separate issue or question.
Portfolio manager Salim Hart is no stranger to our webcast audiences. Here with host Pamela Ritchie, he unpacks the investment case for global microcaps and reflects on the year that was. Enjoy.
Salim, when we spoke to you last, it was sort of mid-year through 2025, and I think it was the anniversary of this new fund that you launched, the one-year anniversary. We were talking a lot about trade at that point and how microcaps actually, to an extent, were protected because they often were selling to more local markets. They're smaller companies. They weren't necessarily globally trading. It was an interesting time then. Just tell us a bit about how that's either changed or some of the new parts that you're interested in right now.
Yeah, I think, in the first quarter, a lot of global markets fared quite poorly, especially U.S. markets, saw pretty significant drawdowns. The global microcap fund was actually up, I think, in the first quarter. So it kind of weathered that storm quite well, partly because of what you said, that a lot of microcaps are very kind of niche, very geographically focused on their local markets and aren't really that exposed to trades. And also they're quite out of favor. So, when you kind of see a liquidity driven sell-off and a lot of unwinding positions, microcaps are typically the first thing that people sell. So, the microcap fund actually provided some pretty good downside protection during that. But I found, as we discussed in June, I found a lot of opportunities, especially in the U.S. on that dislocated sell-off to deploy capital. And I think by I started the year about 1,000 basis points underweight the U.S. and kind of by mid-April it was underweight by only 300. So I rode that back up, and since then the U.S. markets have recovered well. I think I've kind of taken again a maybe more defensive stance where I was kind of aggressively deploying capital in the spring. There's a lot of speculation that has crept back up into the markets. They've kind of reached all-time highs again. And I think, right now I'm finding kind of more opportunities in higher quality names outside the U.S. And Japan definitely continues to be a favorite, but also more opportunities in Europe and the U.K. as there's more fiscal stimulus there and quite attractive valuations.
It's a fascinating asset class that you've told us about before, and I think it has a very large universe. Tell us a bit about what attracts you to this area, because this is a fund that came from it's quite organic to the way you invest. You've created this fund specifically because you like taking a look at these companies. Tell us broadly what it means to invest in microcaps.
Yeah, microcaps are really, I would say, the last really inefficient space in the public markets today. They're really uncovered, they're overlooked, they're illiquid and difficult to trade, which all of that creates opportunities. And there's about 7,000 to 8,000 of them in my universe across the world. I kind of invest in the bottom half of the small cap indices all the way down into the global, MSCI global microcap universe. So a huge number of stocks to sort through. And I think the one thing I would like to point out and dispel the myth off the bat is the microcaps are really not as risky as people think they are. Yes, if you were to buy one microcap stock, it can have a very wide dispersion of outcomes. It could easily be up 100% or down 100% because they have very niche businesses. But when you put them all together in a portfolio, even just looking at the MSCI World Microcap benchmark, it's actually consistently had lower volatility than the MSCI World Small Cap benchmark. So even just the benchmark does, and I feel like the types of stocks I buy, the value stocks, the out of favor names, the higher quality names with ideally good management teams that are taking market share, have a lot of positive qualities and some growth opportunities. I feel like that also provides some downside protection. So I would like to, kind of dispel the myth that you can't have the return associated with microcaps without the risk, without being, very high risk. And I think we've seen that in the fund returns.
We started the month with a look at the U.S. political scene as they head into a pivotal election year. Greg Lohman, VP Digital Advocacy and Policy Communications, and Denise Chisholm, Director Quantitative Market Strategy, reflected on market movements, shifting political expectations, and investor sentiment.
Greg, you spend much of your time discussing things on the Hill with people in Washington. What is sort of the discussion of the shutdowns over? The data has been released again, the happy days to an extent. What's shifted, though, just on the data front within the shutdown? I mean, things have sort of changed. We've marched on without it. Do we need it? What's the discussion?
Yeah, generally speaking, I think folks need it and want it. I mean, that was a historic shutdown of almost 43 days. Anyone you speak to doesn't want to repeat that, but there's a very high likelihood that we could find ourselves back in a dataless government world at the end of January 2026, where appropriators are running up against fast-moving deadlines towards the holiday season, and then how quickly January is going to come at folks to get the rest of the appropriation bills completed from the Senate, move them to the House of Representatives, conference them, come to some agreement, and pass a government funding bill for FY26. And it's just amazing that the progress is just not there. And largely as a result of a lot of hangups around healthcare subsidies expiring, the political realities of 2026, and some many other partisan factors. So we could find ourselves looking for data in the forest again in the end of January. I think the shutdown, I'll leave it to economists to determine what was lost. Generally speaking, I know listening to Denise enough, you don't want to make investment decisions based on shutdown volatility. But one thing we've noticed is, particularly at the regulatory agencies, you pause work for 45 days, call it, and things line up in the queue. And a lot of things get delayed when it comes to some of the more arcane regulatory relief in areas we're seeking with a friendlier regulatory climate in Washington. And so that's something that's sort of impacted at an institutional level. Not something I think you'd want to invest on, but something in the business to business world we're facing as far as, regulatory priorities being held up, and in a pretty significant way when you take people out of work for a month and a half.
So let's go there. Let's talk a little bit about the regulatory framework, in theory, the One Big Beautiful Bill's new foundations that have been built. It's part of, I think, Denise, what you argue going into 2026 will make sure that there's wind in the sails for equity markets. It's not the only piece, but it's one of them. Just talk a little bit about that and what that piece of the policy picture brings to 2026.
Sure. The One Big Beautiful Bill, beyond extending what was the Trump Tax Cuts and Jobs Act, his first bite at reconciliation when he was first president, to lower individual rates, those needed to be extended. So that was really the engine, alongside the fact that the debt ceiling was going to be reached this past summer. It really drove Republicans to coalesce in sort of unprecedented speed, signing that bill into law, surprising everyone in Washington, really, by July 4th. And you have to remember how quickly those first several months of power when you run Washington works for the Trump administration and its Republican allies. His ability to whip his caucus into line and get that through is something that's sort of eroding every day here as we get closer to 2026, just how quickly the political magic dust shifts underneath your feet. But he was able to do it and pass this significant tax reform bill beyond those individual rates, stuff with a lot of policy in there, a lot of stuff that eroded EV tax credits and stuff that was in the Biden administration's Inflation Reduction Act, but also a lot of things that improved capital expensing and depreciation, which we've already seen play out in the market, particularly around a lot of the CapEx spent on artificial intelligence and the ability to, earn cash quickly off those capital investments. And then beyond that, you've got interesting policy that's emerged around things like youth savings accounts, what's referred to as Trump accounts. There's been a lot of news on that front this week with respect to Michael Dell contributing or committing to contribute roughly $6.2 billion into 25 million American accounts. That's a pilot program that would start newborn saving in America from 2026 to 2029. It's something the industry is looking at closely because we know a pilot program won't remain a pilot program for long if it's successful. And if there's a President Newsom or Alexandria Ocasio-Cortez or Wes Moore or President Vance, that program will likely change and in very interesting, uncertain ways. Alongside that, he obviously provided a lot of his campaign promises around overtime and seniors and no tax on tips and a variety of other credits that I think will emerge more and more in the markets in 26. A lot of people are talking about sort of the bump from that law being fully implemented going into 26, which I'll defer to Denise on those cycles. But yeah, the one big beautiful bill as it gets implemented is I think going to create a lot of tax benefits, certainly on the individual side, and then also from a corporate perspective going into the new year.
It's fascinating. And Denise, I'll ask you to sort of pick up on some of those pieces. You bring a lot of data and incredible analysis to everyone joining you here about where we are, not necessarily in a cycle, but what corporate profitability looks like going forward and how you measure that. You take a look sometimes at the wage story, the underlying economic story. Again, just link the one big beautiful bill to some of those pieces, the corporate profitability, the ability for corporations to pay people, to keep wages up at least, if not growing. Just bring sort of that policy piece into the corporate profitability story.
Yeah, that was the most important part of the bill from a statistical or historical perspective, is the drop in the corporate tax rate. So it wasn't a drop in the statutory rate, but it was a drop in the effective rate, almost to the tune of 7 percentage points. So when you look at this historically, and you can measure it on the statutory rate or the effective rate ex recessions, and you will come up with the same results, you do see very clear durability of earnings growth in year one and year two after those tax cuts. And again, if you sort of step back and say, okay, let's look at history, what usually happens in year one, you see a boost in terms of CEO confidence. Check the box. We just saw that. We did see a boost from recessionary levels. And then you see the durability of real GDP growth and earnings growth into that second year. So if you're thinking about the cycle, I always think of 2022 as the ultimate low of the cycle, because as much as it wasn't a recession, it was either a very hard soft landing or a very soft hard landing. But I think we landed because real wages were negative, in some ways very typical of a recession. The stock market contracted 30%, which was right in line with median recessions. And we had a corporate profits recession of about 7 to 10%, which on top of inflation sort of checked the box from a nominal earnings recession perspective. We didn't see massive declines in real GDP, and we certainly didn't see any decline in the unemployment rate. So we almost had a full employment recession. But X that weird quirk of the cycle, I do think a lot of the contraction in 2022 set the stage for the beginning of what could be a 10-year earnings durability and GDP cycle. So going into 2026, you say, well, are we at the end? Are we at the beginning? Is there anything that can shift the odds to make this more durable? And I think we have a trifecta of tailwinds, one of which you mentioned, which is the One Big Beautiful Bill Act, to say that it usually cements durable earnings growth. We also have a more friendly Fed in terms of cutting rather than on hold or hiking. And we also have that decline in energy prices, which is usually related to inflation, which is also usually related to corporate profits. So I think we have a lot going into 2026 to suggest this earnings recovery is in fact durable, which justifies the current valuations we have and makes it very likely that we remain in the secular bull market.
Our final clip today features institutional portfolio manager Alon Collette from Fidelity's Global Asset Allocation team. Alon and Pamela Ritchie touched on a variety of topics, including in this clip, Europe, emerging markets, the overweight and underweights in GA's funds, and a teaser to their January white paper on if we're in an AI bubble.
Tell us about IFA more broadly. So taking us largely to Europe, but other places as well. This is the international story, is something that you were well ahead of, caught it.
Yep.
The question is sort of where does it go from here? Does it continue? How are you allocated and invested towards that?
So right now, IFI, the IFA region, and if we talk about Europe, is the largest overweight on the equity side of our funds, right? So, and that's been there really since the start of this year, or the earlier part of this year, when we thought, you know what, valuations are an important input into our investment process, our asset allocation investment process, but valuations alone are not enough to drive an allocation decision.
Which has been the Europe story for
It
a
has been
very
forever,
long
right,
time. It's
right.
cheap.
It's been the story forever.
Yeah.
I mean, same as emerging markets, right?
Sure.
And I've joked that we've been waiting a long time for emerging markets to emerge.
Yeah.
Right. But
look at them now.
Look at them now.
Yeah.
But same, the same story I would say is there in Europe. Attractive valuations. And I heard this when I was a researcher working down in Boston. We'd do this Europe research trip, and I'd hear this every single year. Attractive valuations, and we're about to turn the corner with these great structural reforms. Every single year we'd hear the same thing, and every year Europe would just get completely steamrollered by U.S. performance. Yeah. And as asset allocators, we have to think in these relative terms, right? So for us, what an attractive valuation requires is some sort of catalyst.
Okay.
And earlier this year,
diversify,
right?
Essentially.
Like to sort of re-rate those stocks, right? And we believe what we saw earlier this year was that catalyst, right? Europe, removing extreme fiscal restraint, defense spending kind of hooking higher, and the performance in Europe this year has not just been defense, right? It's been the banks as well. Yeah. And so we've leaned into that this year, and that's been additive to the performance as well. But to your question, how long can this be sustained? And, is the gas out of the tank in terms of Europe? Because for the last couple of months, Europe's moved sideways, right? Yeah. There was a lot of return, but it's moved sideways.
It was cheap, got bought, and then it's sort of...
It's sort of flattened out. This is where working with our researchers is so critical because, as you know, the funds move incrementally, and over time, if we see different signals, right? If we see that the wind has come out of the sails of Europe based on our research, that overweight would change, right? But as of right now, it's still a pretty significant overweight.
So interesting. So 2026 is a story. Europe is in it significantly.
And Europe was, to be fair, I mean, when people used to ask me about Europe, I'm not sure if I can say this, but when people used to ask me about Europe, I would say Europe's a wonderful place to visit and a terrible place to invest, right? Yeah. So I love going to Europe. Yeah. But anyone who's allocated to Europe instead of the US over the last 10 years is poorer for it.
So let's go to AI and discuss. Actually, you're going to tell us a little bit, give us a sneak preview of a report that you're working on. I think it's not due out to the new year. But the question for months and most of this year probably is AI a bubble for sure? I know that's something you'll start with. So let's go there because it's part of the catalyst question for diversifying around the world and anywhere else, really. Yeah,
I mean, and again, these thought leadership papers that we publish once a quarter, I know they're very well read, and we take a lot of time and a lot of effort to pull in research and our latest thoughts to really address the questions we're getting. I spent a tremendous amount of time on the road this year. I mean, the most I've ever spent in my life.
How much?
I'm at the end of next week, I'll be at 90 flights.
Oh gosh, for 2025.
Yeah, and I think I'll hit 90 nights in Marriott's this year. So I don't know if that's a good thing or a bad thing. Well, probably a bad thing, but the conversations that I've had with thousands of advisors coast to coast inform what we choose to answer in these papers. Our goal in these papers is we want to answer exactly the questions that we're getting in a jargon-free manner, right? So using the Bloomberg way, so to speak. Yes. Jargon-free and in the most accessible way possible so that these are helpful to advisors. And even in the case that an advisor may disagree with our view, at least they fully understand why we have the view. And so one of the questions we've been getting quite a bit is AI a bubble? And for this, we have to look at, again, the researchers that we work with. One of the pillars in our investment process is a bottom-up. So myself, David Wolf, David Tulk, we all come from the macro world.
You all incidentally come from the Bank of Canada.
That's right,
as well,
right. So 20 years of experience roughly combined at the Bank of Canada and Bloomberg. But what companies are saying and doing matters just as much, right? I mean, as an economist, it's a bit humbling to say what a company is saying and doing today shows up in the economic data 6 or 8 weeks later. Right. And earnings revisions, particularly in the US, have been pushing higher, right? And for that reason, we have to really push back on this idea that the AI expansion is strictly a bubble, right? It could be this sort of once in our lifetime productivity innovation that we can't necessarily lean away from. So in terms of what that means for positioning, we are underweight the US equities right now, but it's a bit nerdy, but we can use futures overlays to short out specific parts of the market, you know, perhaps small cap, right, which are not overly profitable, and keep great managers like Will Danoff, Mark Schmale, who are invested in the AI themes, fully invested,
Right.
and benefit, and we can still benefit in our funds from that theme.
Without having to be all in on that particular discussion.
Right,
but,
exactly.
but you wouldn't be there, for instance, if you thought, you know, which they aren't, investing in a bubble.
No, exactly. And I mean, again, we work really closely with our underlying managers and our researchers to examine this very closely. But it speaks to the importance of having diversified sources of returns, right? So, I mean, our concern really in the US is, I would say, more to do with some of the underpinnings of exceptionalism coming under attack, right? A politicized Fed, what that might mean. And for us, that's really also resulted in a significant change in how we're positioned around the Canadian and US dollar.
Thanks for watching. I hope you enjoyed those clips. Each clip was from a full 30-minute video podcast, which are available on YouTube, Spotify, Apple Podcasts, and more. Also, here at Fidelity Investments Canada, we're putting out fresh content daily. So please look up FidelityConnects or the Upside podcast for more. I'm sure there is something there for everyone. The Upside, as you know, starts as a streamed webcast where you can learn to be a better investor and hear from some of Canada's best stock pickers and leading financial experts. We've got a good week, month, and year in store, so to not miss a show, head to fidelity.ca and sign up for the next webcast. Thanks for watching today, and I hope you'll join us again on The Upside. I'm Kyle Cheropita. Thanks for listening to, or watching, Fidelity Canada's The Upside podcast. Subscribe on your podcast platform of choice so you don't miss an episode. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on LinkedIn, YouTube, Instagram, or X. We'll wrap things up today with a quick disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.